Europe is headed for recession, led by Germany and Italy, and with Central and Eastern Europe in the background. According to JP Morgan Chase analysts, annual growth in the euro area is expected to be just 2% this year, minus 2.5% in France, and minus 3% in Italy. These troubles are likely to trigger jitters in the bond markets. And rising energy prices are a cause for concern for European politicians. Portugal financial crisis. The Portugal financial crisis occurred in 2010 and 2014 and was part of a broader downturn in the Portuguese economy, which began in 2001. The Portuguese government recently presented its state budget for 2022, which includes a macroeconomic scenario. The finance minister pointed out that the country would be one of the EU's fastest-growing economies in 2022. Nonetheless, Portugal's economy faces many structural problems. Among these are the rising unemployment rate, the high level of public debt, and a lack of infrastructure. However, the government appears to be better prepared to deal with current challenges than it was during the Eurozone crisis. The Portuguese financial system has been performing well in recent years, but continued attention is needed to ensure that it remains resilient. It is crucial to ensure that bank capital buffers are sufficiently strong and that the Portuguese banking sector remains competitive. In addition, structural reforms are necessary to unlock the country's economic potential and accelerate income convergence with the rest of the euro area. In this regard, the National Recovery and Resilience Plan focuses on long-term structural needs and climate change. Greece financial instability. In the run-up to the Greek financial crisis, the country enjoyed one of the fastest-growing economies in Europe. Low interest rates, high public spending, and strong inward investment all contributed to a boom. The Greek government boasts of economic growth of 8% last year, and 4% by 2022, but these numbers have little to do with reality. The country is currently mired in political turmoil, and recent wiretapping revelations have exposed the authoritarian tendencies of the ruling elite. Fears of escalating social tensions are also a factor. As a result, the Greek government has faced a difficult challenge. Its lack of political rival has provided space for structural reforms, but the lack of political competition has also created an environment for inertia. Many influential actors in Greek society are comfortable with the status quo and put pressure on governments not to change. Ireland financial uncertainty. The economic crisis in 2008 impacted the entire world, including Ireland. The financial crisis affected the availability of credit and caused asset values to plummet. This left Irish banks in a parlous situation, and the government of Ireland reacted in extraordinary fashion to shore up its banks. It injected large amounts of capital into failing financial institutions and nationalized two of its largest banks, Allied Irish Bank, AIB, and Bank of Ireland, BOI. This caused a huge increase in government debt, and credit became more expensive for consumers. Ireland's financial sector has rebounded from the financial crisis and is now healthy and well capitalized. It is operating within the guidelines set by the European Central Bank regarding bank capitalization. However, the stock of non-performing loans remains high. As a result, Irish banks are continuing to sell non-performing loans to investors. In addition, the Irish government is actively selling its stake in BOI. It has decreased its ownership to under 6%. Meanwhile, it has signaled its intention to sell its holding in AIB by mid-2022. Ireland's financial crisis could affect the economy in several ways. First, it could lead to more houses on the market, and this may cause consumers to lose confidence in the economy. Second, it can lead to a recession. Third, it could cause inflation. Recent data showed that the Purchasing Managers' Index for manufacturing in Ireland was 51.5, which means the economy is expanding. However, this reading is close to the contraction zone below 50. In addition, new orders fell at the fastest rate since January 2021. Spain financial crisis. The 2008-2014 Spanish financial crisis is also known as the Great Recession. It was triggered by the world financial crisis of 2007-8. A Spanish recession started at this time. The country's economy shrank by almost 20% between 2008 and 2014. As a result, unemployment and house prices rose. However, the economic crisis did not affect the Spanish economy as much as in other countries. Overall, the Spanish economy begins its financial crisis. The country is facing a difficult period. The Spanish government is predicting economic growth of just 4.4% in 2022. In the first and second quarters of 2022, Spanish economic activity increased by an average of 6.8% year-on-year, but it was expected to slow in the third and fourth quarters. However, the economic outlook in Spain is a mixed bag, with various elements of uncertainty complicating the outlook. While the overall outlook for the country is still positive, the country is facing a number of headwinds such as a pandemic in Ukraine, a rising energy price, and a weak labor market. Cyprus financial state. The Cyprus financial crisis is a textbook case of an over-regulated banking sector causing a financial crisis. This country had an unsustainable level of debt, government deficits, and collateral damage from previous bailouts. Despite the need for a bailout, the amount needed for Cyprus was comparatively small compared to the country's total GDP. However, the Troika was unwilling to fund the full amount of 10 billion euros Cyprus needed. As a result, the Cypriot government was forced to bail in its banking depositors. This attempt to spread the pain was rejected in the Cypriot parliament. The two biggest banks had about 46 billion euros in deposits and 184 million euros in uninsured senior debt. The lack of a lender of last resort in Cyprus has prevented it from functioning as a normal Eurozone member. Moreover, it has refused to use the bailout capital to support its banking sector. In contrast, other Eurozone countries have allocated bailout capital to banks and allocated resources from the official sector to support them. Cypriot's failure to support the banking sector has increased the risk that the country's government debt crisis will lead to a financial sector crisis. At the same time, it has undermined the effort to meet debt sustainability goals.